Hello and welcome to the Leadership in Insurance podcast. This podcast is brought to you by FinPro Search Partners, the executive search firm for the insurtech industry on an international basis. We'd love to hear from you. If you want to hear a bit more about our recruitment services, please visit www.wearefinpro.com. I hope you enjoy the episode. Good morning and welcome to the Leadership in Insurance podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by Quentin, who is COO of OTTRISK. But that was a lot of letters in a row there, Quentin. I thought I was going to get that wrong. Quentin, good morning. How are you?
I'm great, Alex. Thanks for having me.
Yeah, no, not at all. No, thank you very much for being a guest. So, as is customary on the Leadership and Insurance podcast, it'd be great if you could introduce yourself and of course, the OTTRISK business.
Sure. So my background is in finance mostly. I've been working more or less 6 to 7 years in different roles in asset management and insurance. So initially working on the buy side, I moved to investment banking to cover insurance and reinsurance for matters that range from M&A, so mergers and acquisition, to financing. But, as you can tell, I'm not an insurance insider, so I wasn't a broker or an underwriter before. I was fortunate to meet the founders of OTTRISK 2.5 years ago now. We had an alignment in principle, and I obviously made the switch from working in a big corporate world in a startup. So that was exciting. So today I'm the COO of OTTRISK. We're MGA that develops parametric insurance for business interruption. So I'll get into some of that later. But in a nutshell, we serve different industries that range from retail, leisure, hospitality, travel, real estate, and digital marketplaces. The underpinning principle in our coverage is that we use data indices to underpin our policies or contracts. And we basically chose those indices so that they correlate very well with the loss experienced by the insured. But so that's, the broad description of OTTRISK. Company was founded by two Silicon Valley entrepreneurs, David Soloff and Shomarth Palihapitiya. So David has 3 decades in entrepreneurship. Shomarth is a Silicon Valley investor through his social capital fund. The two of them have collaborated in the past before, and that's their second partnership together. So briefly on OTT, we're a team of 8. We're fully remote, so that was quite an interesting experience. We only fully met as a team a couple of months ago after 2 years in business. That tells you something. But we managed to get that far. So yeah, I'm excited to be here and to talk business interruption with you, Alex.
Yeah, brilliant. Thank you. And business interruption is something we've talked about a few times on the pod, so I really want to dive into that. But I'm always interested in this kind of genesis. Now, I don't think it's that unusual anymore. We're usually talking to people that are in a kind of startup or scale-up environment. We're usually talking to companies that are quite new, but it's easy to skip over how much of a shift that is to sort of go and work fully remote for a company, but particularly a startup company. I think it's a different thing to sort of take a role remotely with a established business, because onboarding tends to be really slick, the systems are there, it's all kind of got together. But you're talking about joining a really early stage business. It's still only about, how many people at OTTRISK now? It's about 8 people, isn't there, I think, in total? Yeah. So it's how you said there's an alignment of kind of thinking. How did you guys meet? And then how did you kind of make that decision? What went through your thought process? Because I think that's interesting to our audience, because a lot of people are we're talking about remote first companies. Like, we recruit for a lot of companies that are fully remote, and particularly people coming out of insurance are still kind of adjusting to that role of going, it's a small company, it's got limited funding, we've never met before. How do you make that leap of faith?
Well, I think whenever you get in the startup world, you need to be mindful that it's going to be chaotic one way or another. So you're in for a ride, whether that's remote or not. The upside package that you get from there also helps you make the leap, I guess. I think you have to be in a certain stage in your mind. I mean, I'm talking through my own process here, but
Of course.
I was kind of bored of being in a big corporate where you don't really see your impact. And whenever you meet people, whether that's through the internet or in person, and you jam with them on some cool ideas or values that you share, and you see a path forward, I guess you just need to ask yourself whether or not you want to take a risk and make the leap. For me, it was easier because I don't have many responsibilities. I don't have a kid yet, not married. So obviously, the more you wait, the more this become a bigger consideration. But at the same time, in entrepreneurship books, they always tell you that it's never the right time and you will always find a reason not to do it. So I guess you just need to be in the right mindset. My personal experience is that I met the founder personally. I happened to bump into one of them on holidays and, just had a quick chat with them. But yeah, if I talk about the other 7 employees, I think most of them are following the same type of process. We're all very excited about designing something that works for business interruption insurance. We all have some kind of emotional stake in finding a solution. So that's what keeps you going for sure when you're fully remote, because it's been incredibly difficult, to day connect on Zoom and stay motivated. But I guess when you have that, you are motivated and you see you're able to see why you're working for something. Whereas if you were joining in a bigger corporate, of course the process is very structured. You have maybe a better job security, but from a mental health perspective, it might be different because you don't have that fiery passion when you wake up in the morning the same way you could have in a smaller environment. My 2 cents.
Yeah, no, I'm always intrigued to kind of take the opportunity to ask that question because, obviously I run a small business. There's 4 of us. And, the one thing that I've always say when I'm, we specialize in working with earlier stage companies. So, there's a kind of false narrative of that you're safer in larger companies, but we've only got to look at some of the larger tech businesses lately making these huge layoffs. And I said the great thing about small businesses, I don't think there's any surprises. Like if you're in a small startup and it's not going well, the numbers are usually literally written on a board somewhere, and we can all see them, and we have visibility, and there's that line of communication. So yeah, I was intrigued. I'm always intrigued to ask someone's personal journey, but let's get back to business interruption. Silicon Valley investors, you're not from the insurance space. Why was business interruption the challenge that you as a team decided to tackle? Because obviously there are a load of challenges in insurance that you can address, but why specifically was business interruption the space that you wanted to attack?
So I think the underpinning realization is that, today our society is much different than it was decades ago. In other words, the economy is increasingly growing intangible with technology, with many different things. And so today, less so, and I mean, it's becoming less common to see big business disruption caused by just physical damage. And, what that tells you is that today the insurance paradigm is very good at covering any kind of interruptions that follow a damage to a commercial property, but less good when it starts to, go into the intangible realm. So that's the main realization. The aha moment was COVID, of course, because you've seen a business loss at scale that wasn't tangible. your roof was still there, but no one turned up to your restaurant or to your hotel or what have you. So that was the trigger, I'd say, in the founder's mind to say, well, I've been thinking about this for a few years, and now we have our poster child for why we need this. So the insurance industry, you can, looking at innovation in insurance today, you could innovate in many different ways, whether you disrupt the distribution through embedded insurance or a business line like we're doing. I think that talks to the fact that we're very driven to essentially bring a better solution for small and medium businesses. Because if I take a step back with the pandemic, if you're Walmart or large corporate, yes, you're going to suffer, but worst comes to worst, you have cash, you have contingency planning, and you can raise money in the capital markets, whether or not they're depressed. If your average Joe in the corner shop, whether you're selling flowers or your hairdresser, and you're an independent business owner, you're gonna get smashed by those kind of events. And when you're in that line of business, maybe you have cash for 1 or 2 months, and then you're out of money. So really, there needs to be a solution for this in business interruption. That doesn't mean business interruption is solely a SME problem. It's obviously much bigger than SMEs, but I think that's where the vision came from. So I can give you a few quantitative examples of what an intangible business interruption event might be, because we think about the pandemic, but there are many different other events that could be meaningful. So social unrest, being French, I know a lot about the Gilets jaunes. I don't know if you heard about that, but it's basically a protest that was going on in the 2018-19 timeframe. And a quick quantitative measure is that whilst there was 200 million euro of claims paid in damages by insurers, the business loss itself was measured around 2 billion plus, so 10 times bigger. And that wasn't covered because most of that loss was driven by people that could not come to a venue because of the protest, rather than the protest damaging a venue, if that makes sense. So that's one example. Terror attacks. You saw large dips in hospitality and travel after the Bataclan attack in 2015 in France, or after the London Bridge attack in 2017. So whilst the attack might be, quote unquote, as small as someone knifing someone else, which is horrible, you still stand to see a big drop in your business activity if you were somewhat in the same area. So these events need not be systemic, because that's the usual argument that the insurance industry is using, is that we cannot cover systemic events. But the reality is that they don't have a way to cleanly measure those intangible events, and there is a big bunch of uncovered perils that are not systemic, and that's really what we are trying to tackle here.
Well, I wanted to jump in on a few things. What's your method of distribution? Are you still utilizing brokers as your main method of distribution, or can people buy direct, or was it both?
So, well, I can talk about brokers. Brokers have been super useful and great to us, especially in the beginning, because say what you will, they are experts about insurance, and we were we were pleased with the level of creativity that they've had when they talked to us initially, because really when we launched the business, we didn't really have an idea of where to start, and some of the large brokers were very forthcoming in ways to operate. So most of our business today is sourced through brokers. So specifically, we started in what's called alternative risk transfer. So that's mostly broker distributed, and we've worked with large companies to create bespoke solutions. What that helped us do is, get a better understanding of what is the business data that matters most for those large operators, because you can bet that those operators are using the same metrics that a SME or a medium business would be using. So from a product definition standpoint, it was super useful to work with brokers. The flip side is that it's a very slow cycle. When you add intermediaries in your chain, especially as a startup, getting product market fit is harder, in my opinion, because you're being managed in your expectations by the broker, and they're doing the same for the client. You don't always know why you're not selling your product. Is it too expensive? Does it miss the mark? It's not always easy. And the main point is that your sales cycle is longer. So as a startup, you need to operate and iterate very quickly, especially when you're talking about problems that are shifting, as we speak. And that would be the flip side of a broker distribution. So today we are trying to diversify into direct to consumer. I can talk later about the Lloyd's Lab and what we built there with one of the syndicates, but it's we are increasingly thinking about ways to embed our products directly into customer interfaces.
Yeah, I mean, because I think one of the things, so I think SMEs, it's different in different geographies, of course, but obviously I buy my own insurance, and I don't use a broker. My business isn't complicated enough to need one. There's good off-the-shelf package solutions as a starting point. But secondly, I think the biggest problem with business interruption that we always talk about, and it's constantly talked about, even in the press. I mean, in the press, it's quite often talked about unfairly because obviously COVID happened. Hiscox got dragged through the courts, rightly or wrongly. I know, some of the commentary I had from the market was the reason it was so public about the business interruption gap, or was more that Hiscox has made such a play for small businesses, and small businesses basically don't understand the insurance that they buy. So one of the challenges, I would imagine, for a business like yourself that's focused on business interruption is that there's an education gap there. When people buy insurance, they don't know that they need business interruption insurance. They probably don't even know, a lot of them, what it is. Is that one of the challenges you've foreseen? So, is that something that you've kind of thought of a way to get over?
Well, I wonder if you were not a rogue employee for us, because you're saying exactly what we've lived through. So, I mean, that's totally right. I was saying earlier that in our minds, the product makes most sense for SME, but the reality is that you have that education gap. Parametric products are still very much, I'd say, a CFO suit product rather than a risk manager product. And that's increasingly true when you go, down in the number of employees per company. So that's why brokers were also useful, because having a trusted figure in the room to educate the risk manager, saying the same words we're saying, but they trust the broker more than us. That was one of the ways we dealt with that. The other issue, though, beyond education, is just budget, because whilst from an ID standpoint, it made the most sense to launch that during COVID. At the same time, people have limited budget to take up new insurance products. And if anything, they always say insurance is sold rather than bought. People have a fixed budget in mind, and they're just reducing that rather than expanding it. So that's another frustration. But that tells you that whenever we pitch or we talk to customers, we try to find ways to self-finance that premium. So a quick example would be that in some instances, you could think that having a business interruption cover makes your credit risk slightly more attractive, and maybe you can get financing at a cheaper cost if you're a medium or large company. And that's a way they can, take the delta in financing savings they make to buy an insurance product that at the end of the day, they're not going to reimburse because they paid the premium. When you take up debt, you have to pay back principal in interest. Whereas if you take an insurance product, you pay a premium and that's it. And if something happens, you get paid with your principal. So it's a different type of financing consideration. Hence why it's a CFO more than risk manager discussion, in our opinion.
Is that, I think you've said about embedding it on the journey, but presumably just having that conversation alone, there's more opportunities for distribution via partnership. In the same way that like a lot of cyber, we work with quite a lot of cyber technology or cyber defense companies, and they're working with insurers to build products, and they embed the cybersecurity solution, and that has a effect of reducing their risk exposure, and therefore it gets cheaper premium. Is that maybe the distribution model that you'll follow, is like building your parametric BI cover into some of the kind of coverage that probably where there's a BI gap, rather than the insurer going and creating their own kind of BI gap? Is that one of the methods of distribution you've looked at?
So, I mean, very early on, we thought about, because obviously business interruption can be caused by many different things. So you have cyber, you have terror attacks, you have social unrest, pandemics, what have you. So for instance, in the beginning, we looked at offering this as part of broader consultancy packages. Like you would have a cyber consultant that would somehow recommend a number of like recommend different recommendations following an analysis of a business, and one of those might be take up cyber insurance for outages or business interruption, and you would slot that in. I mean, we became more mindful of, so that's a valid consideration, but the way we're looking at embedding today, it's more about finding a platform. So for example, a marketplace that already has a lot of clients buying their main product, and embedding this insurance business interruption protection inside their existing product as an added feature. Reason being, premiums are smaller, amounts need not be large. Like also, it's a less tedious sales process to already capture an existing customer rather than find it. So I give you a more traditional example. Imagine tomorrow a broker comes to me and say, hey, I have this hotel in Oxford Street, they need cover. What can you do? That's a very, bespoke inquiry for a small team. That's not really what we're looking for, even though we're happy to help. Rather, the way I would think about hotels business today versus 1 year ago, which is what I just described, is, well, we know large groups of hotels are mostly, franchisee operated. So they might own all the properties, but maybe 80% of them are run by a franchisee. So what about using the group as a platform to distribute to franchisees, and maybe the group hotel gets an additional income stream through commission, the way a broker would, by effectively being a pass-through to different franchisees in different regions. And that way you also, from a risk perspective, build something they've diversified much more quickly than you would by just going one-to-one to different inquiries, which also might be more driven by adverse selection if you think about it. Because the ones that would come to us are not necessarily the better risk.
Yeah. I mean, I remember having that conversation with someone about we were talking about the theory of trying to launch a new auto insurer in the US. And he was saying, yeah, you can get loads of customers, but the customers you get are the ones you don't want because they're the ones that can't get insured elsewhere, which is always the challenge. So where are you on the development journey? Have you've got specific discrete products that you're distributing, presumably not just these kind of individual bespoke as we just discussed with the brokers, and if so, which products have you kind of got on the product suite so far?
So I guess I described our business today in three verticals. We have our legacy business, which is all those large corporate inquiries that we generated over the last 2 years with brokers. So as I was saying, it's a very slow sales cycle. So there are discussions that have started a year ago that are still ongoing and that will or will not close at some point in the coming year. Then from everything we learned there, we designed commoditized industry solutions that are much more scalable or basically quicker to iterate for us. So you might have, so as I was saying in the beginning, we have solutions for different industry verticals, retail, leisure, travel, real estate. For each of those, we have data that underpin the indices. So I'll just talk quickly about the product. Basically, parametric insurance has to date focused mostly on, weather impacted industries, whether that's, agriculture, energy, if you're a wind turbine or solar panel, or nat cat driven losses like Florida wind or earthquakes in California. It's a very crowded market, the parametric insurance for climate. So we made the leap of taking the same approach, but for business more broadly. So today we benefit from a very broad data regime that we didn't have 20 years ago. So if you're an hotel, what's driving your revenue? That's your occupancy rate and your revenue per room. We get that data through private and public sources. We can design a trigger that say, okay, if over a month or a quarter, my occupancy drops below X, say 70%, when I usually expect to make 90%, then I start paying you out. That's an outcome-driven payout more than a cause-driven payout, which is usually the way insurance works. You need a cause, then you get paid. So obviously, people will jump and say, oh, but what do you exclude and how do you exclude things? What we have two ways of excluding. One is traditional, through traditional wordings. The other is through structuring. So what I mean by that is if you think about severity of loss and duration of loss, you can start thinking about what you're going to cover. If you're saying I'm only covering a 15% drop over a week or a month, that's a very bad weather for your retail store type of event or a rail strike. If I'm covering the drop that is minus 50% over a year, that's your pandemic cover. So you can start designing the types of events you want to cover by how you're setting the parameters of that index. The beauty of it is that because you have decades of data, I don't need to, obviously having a track record is better, but I can recreate the track record of any policy by just implementing a structure and then looking at the historical data and seeing when it dipped below the level I set. And that gives me a sense of how many times I paid, how much I paid, and how much money I made or lost over the period. And that way, that's a way to basically show an underwriter why you would or would not insure that risk. So that's exclusions or other events that I want to cover. that's also how we tap into the intangible, because obviously that data will not matter whether you had physical damage or not on your property. If something impacted your business, you're gonna get paid. So that's outcome driven payouts. And for each of those industries, we have those indices that correlate well. So travel, maybe you're an airplane, you're an aviation company. We can measure the revenue passenger kilometers you've done over a route between airport A or B, over a country to a country, what have you. So the data partners that we have, so that's the last point on this, are independent and reputable consumer brands. So there is an argument to be made about black box models. We don't want to insure based on a black box index. No one's going to buy that. Rather, we use guys like MasterCards for card transaction data that everyone can trust. They stand to lose more reputation-wise by tampering their data. So, a consumer can trust that this data will correlate well with the receipts they made over the same time frame. So that's number 2, commoditized solutions. Number 3 is very recent, and on the back of the Lloyd's Lab, we increasingly focus on the digital economy, things like Airbnb for hospitality, transit, Uber, for example, food delivery, DoorDash, Deliveroo. Those type of businesses that, as I was saying before, already have a big community of users where you can effectively embed that cover inside one of the features of the platform. So specifically, you have a supply and demand for something. So if you take Airbnb, it's a roof or an apartment. We focus on the supply side, more specifically on a subset, because as you know, I mean, I'm not an Airbnb owner, but I would suspect most of the owners on that platform do it for leisure whenever they're not in their flat for a week or two. A very small subset will use it for business purposes. You have hotel management companies, or you have owners that have taken 6 or 7 mortgages and have 7 properties, and they need to make a yield on those. And effectively, the way you would do it is you would have a business interruption guarantee that protects the downside on that yield, so that you can at least meet your mortgage payment or whatever fixed costs you have. And that's a key differentiator for those platforms, because you're embedding a protection that reduces earnings volatility for your users. So that's, the evolution of number 2 to number 3 is basically baking in distribution into it and diversification, because you get access to a pool of risk rather than bespoke selection by X or Y operator.
I was going to ask, like, it must be an interesting reinsurance conversation to have around this sort of exposure, because there's a good reason why certain insurances aren't offered. I think that might be the counter argument. If we see what happened post pandemic, like wordings were tightened up, post 9/11 wordings were tightened up on kind of certain aspects. Business interruption would kind of fall in the place that you might tighten wordings or kind of not want to pay. Have you had any conversations about what a reinsurance challenge that might be? I mean, I appreciate your operating as an MGA, but that is always a kind of consideration.
Well, very initially, we focused more on reinsurance and insurance, actually. So those large contracts were designed to be reinsurance cover for insurers that back the large corporate. The issue we have here is that when you have a traditional indemnity bunch of exposure on the insurer side, and you're coming in with a parametric index to reinsure it based on some measure of business activity in a number of industries where they're exposed, you have basis risk because the two correlate much less neatly than it would at the primary side. So that's why we later on went to insurance. I mean, what I want to say, ideally in a status quo at the future stage, you have a bunch of insurers that underwrite more parametric contracts so that at the reinsurance side, that problem goes away, because now you can point to the same indices. So for instance, some of our corporate deals, we have a fronting insurer that effectively just use the same construct and pass through all the risk back to us, whether on a quota share or excess of loss basis. That way it's kept clean. The problem with reinsurance is when you have an indemnity product at the primary side and you're coming in with a parametric index to reinsure behind. We've had a lot more resistance this way, so I don't think the industry is anywhere near to take up that product in its current shape as reinsurance.
Yeah, exactly. I thought that would be a specific challenge. I'm conscious of time, actually, Quentin. So I wanted to talk to you about your experience at the Lloyd's Lab. You've obviously just gone through the 9th cohort. How did you find the experience? And what did you achieve in that period of time?
So very succinctly, we came in to design a product that was better suited for SMEs in retail and leisure in the UK. That was the pitch. So the biggest value add we got from Lloyd's was access to a network of insiders. When you're a bunch of nerds like jamming about your product, you think it's the best in the world, but unless some insider tells you that you're full of shit, you're not gonna make progress, right? So that's the biggest value we got out of it, was to meet with people, and that we did. And we were fortunate to meet Apollo, the syndicate from Lloyd's, who later became our mentors. And they were the Kickstarter for that whole digital marketplace branching, if you want, because they're the leading syndicate for digital economy. So they already had a bunch of clients there. And now we're working solidly with them to design something. As a matter of fact, they backed us with their risk capacity. So that's a great achievement we've had over the 9 weeks in the lab. So now we got what's called the line slip with Apollo, which basically allows us to submit any risk to them, and upon review, they can underwrite it. In the lab, really, it's, I mean, if I can tell your audience to do it, it's really about getting exposure and getting that product check from people and being backed by great mentors. For us, it was tremendously valuable. I mean, I see now that I've been in a startup for 2 years, I see that it's controlled chaos in a way. You have an idea of where you want to go, but you don't know which piece of the puzzle is going to come next. But you just got to be flexible and, take what you can. And the lab was one of those key milestones that allowed us to make progress also with other insurers and underwriters, because as a MGA, and more broadly, I'd say, is even though we initially came at it with an idea of underwriting risks ourselves, we quickly realized in insurance that you cannot have an exponential sales model. The capital will be your limiting factor. And so you need as many counterparties, underwriters as possible to get to solving that problem. The reality is that you cannot solve the business insurance protection gap. It's trillions of dollars, and the insurance industry doesn't have enough money to do it. However, we think that that line of product is relatively untapped, like parametric insurance using business metrics, and it would be beneficial for both the insurance underwriter side, but also the buyers of insurance to, push that product forward. So I'm always amazed when I hear one of the big, brands in insurance, like the top 4 reinsurers or the AXA or Allianz of the world, thinking of us as competitors when in reality they could extract more diversified premiums by doing that approach. So I think it's time people look at this in a collaborative way a bit more, because the buyers need them for sure. And in reality, we think we have a way to, cleanly divide those intangible risks that I talked about in a less scary way than they think they are.
I think
So yeah.
yeah, sorry, I was just going to dive in because I think I'm always listening to this with sort of two heads on, one on the sort of host of a podcast head, but I'm also sitting there looking at saying, well, I own my own business and I run buy insurance, and it's just more. I don't think it's as clean cut as I want an indemnified policy for. I now want an indemnified policy for certain things, but for example, business interruption for me is the perfect use case for parametric, because the amount of times that businesses are waiting 6 months to get their claim paid on business interruption piece, and they've gone out of business because they don't have enough cash flow, and particularly for SMEs. I used to run a retail outlet a long time ago with a former partner, and we'd have things that would interrupt business and it would get shut down, and whether it be flooding of like the space that we were, or and that's obviously specifically flooding. But if you extrapolated that, and I was an online store and I had internet outage, there's so many reasons that for us it was like cash flow was such an important thing. So kind of parametric and that instant payment and the kind of triggering events is so critical to the successful running an SME. I just still think this is it's not as I want insurance policies now that are not just one thing or the other. It's like, which is the most suitable method of insurance for me at that time, and that feels to me like the evolution that we're part of at the moment. Quentin, I always want to give you the final word, so but just conscious of our time. So, what's coming up for you guys in 2023? Start of a new year. What can we look forward to from OTTRISK?
Well, like I was saying, we doubling down on the digital marketplaces. So we have a bunch of deals that might close in the coming quarters from the legacy side, but really the next few quarters will be focused on getting a pipeline of digital marketplaces, or, for lack of a better word, a distribution platform with diversified pools of risk that we can access. To your point, I mean, if I make a quick segue, the way you're going to distribute at scale to SMEs or small business owners is not through education. I think it's through frictionless, insurance, embedded insurance. If you tell an owner on Airbnb that they can somehow guarantee $7,000 of their 10,000 expected over the coming year for an extra $50, they're not going to look at the fine print. They're just going to sign it up. So then later on, when you start building some kind of momentum, people start asking the question, oh, well, those early adopters have done that. What does that mean for me? Can I benefit too? Can I ask my insurer to give me that kind of coverage, which is basically an income protection or business interruption, disguised business interruption cover? We think it's a way to make change at scale, is basically make it as simple as possible to understand for the customer. On the back end, let us work with underwriters and insurance companies to make sure they're comfortable with the risk they're taking, and that can be as complex or tedious as it needs to be. But for the consumer, it's about simple and fast change, and that's really with that idea in mind that we are, entering the new year. So marketplaces, we have several other opportunities around financing of risk. So what I hinted at earlier with credit risk, we have a few use cases with larger companies here, and also supply chain delays, even though that's becoming less of an issue these days as the China's reopening. But we've seen a lot of disruption, especially in the West Coast of the US, with supply chain delays, and we've had good conversations in Lloyd's to do something here. So yeah, I think that's the main message is creating a simple and broader protection for, you know, the SMEs or business owners of the world, and making sure insurance is a participant rather than a side watcher in the process.
Yeah, lovely way to end it. I think it's really funny sort of coming full circle. I mean, the podcast's about 2 years old, and yeah, it's funny to have this. We launched it in the pandemic, which BI was all the kind of conversation, and then since then, you guys have gone and launched a sort of solution to that. So that's kind of perfect entrepreneurship in a nutshell. We're definitely out of time. So Quentin, thank you so much for being a guest. I really appreciate that. Love Parametric Product. Yeah, really kind of you to spend some time with us. Thank you very much. And yeah, we look forward to seeing you soon.
Thank you so much for listening to the Leadership in Insurance podcast. As ever, this is brought to you by FinPro Search Partners, the executive search firm for the insurtech industry on an international basis. If you want to find out more about what we do from a recruitment standpoint, please visit www.wearefinpro.com.